Hi, welcome back to this my seventh and last data update for 2023. And since it's already March, it's only 9 months until the next year's updates anyway. And in this one, I'd like to focus on dividends and buybacks. In other words, cash returned by companies to their shareholders. I'm always mystified by why people think of dividends as some kind of loser game, that a company that pays dividends is in a sense giving up. Because to me, dividends represent the other end of a startup. The way I think about businesses is when you have a startup, you're seeding the fields like a farmer, and then you nurture the fields, you grow the crops, but ultimately you do it all because you want to harvest the crops. Dividends to me represent that harvest. That said, though, there's a lot of misunderstanding and myths that spin around dividends and in particular buybacks. Just to give you a sense of how much heat buybacks evoke, let's take two stories that in the last 2 weeks I've seen with buybacks part of the story. The first was with the train wreck that you had in Ohio, where you had a chemical spill and people were having health problems, a terrible accident. A company called Norfolk Southern, and people argued that the accident happened because Norfolk Southern had done buybacks 2-3 years ago, and that was the cause for the accident. We'll come back and address that, but that was the first story. The second story was a couple of weekends ago. Warren Buffett mentioned he was talking about buybacks, and Warren Buffett used to not think much about buybacks, think much about buybacks in general. But for the last decade or so, Berkshire Hathaway has been buying back stock. And Warren Buffett talked about the critics of buybacks, and he used words that were pretty strong for him. He called them economic illiterates and or silver-tongued demagogues. And we'll come back and address why he used those words. But clearly, he was talking about buybacks as well. And finally, just as a story that goes back a few months, as part of the Inflation Reduction Act of 2022, one of the things that was put into the tax code was an additional tax on buybacks, a 2% tax on buybacks. So when companies buy 100 million of their own stock back, they'll have to pay 2 million in taxes. Now, one reason, of course, is to collect revenues, and I have no problem with that. But there's also a subtle message or not so subtle message that was in the legislation, which is buybacks are bad. We want to discourage companies from doing buybacks. And I want to come back and address that point of view. So let's step back and think about where dividend policy, which is where I put both dividends and buybacks, fall in the bigger picture of corporate finance. You've seen this big picture before, especially if you've taken one of my corporate finance classes, and essentially I summarize everything that a business does into three big decisions. The investment decision, where a company decides what projects to take, what assets to invest in, and that investment decision is driven by a very simple principle, which is when you go out and invest, you need to make sure you earn a return that is greater than your hurdle rate. The return is measured based on cash flows, should reflect when the cash flows come in, and the hurdle rate is your cost of funding, the cost of capital. And if you've been watching the previous data updates, I think in updates 3 and 4, I talked about how the hurdle rate has gone up for companies across the board in 2022. And in data update 5, I talked about how difficult it is for companies to make that hurdle rate, even in good years when the hurdle rate was much lower. And noted that about 70% of all companies are not making returns that meet the hurdle rate. So the investment principle, at least you can see what companies need to do. Many of them are not doing it, at least for the moment. The financing decision looks at the mix of debt and equity that you should use to fund a business. That was the topic for data update 6. We talked about how to come up with that mix, both qualitatively and quantitatively, and how companies often deviate from that mix, either because of inertia, because they've always taken on debt or never borrowed money, or because of Me Tooism. Everybody else in the group is borrowing money, you're going to borrow money as well. Which brings us to the dividend decision, and it's a very simple one. It says, look, if you cannot find investments that make your hurdle rate as a company, and among that 70% that are having trouble, maybe for 30 or 40%, they're just in bad businesses, just give the cash back to the owners. Now, whether you do it in the form of dividends and buybacks will depend on what your shareholders prefer to get, and we'll come back and address what that might be for any given company. But that's a dividend decision. So in a world where people are approaching dividends logically, it is a residual decision. It's whatever's left over after you've met every conceivable need. So in a world where people think about dividends as a residual cash flow, here's what firms should do. They should first go pick the best investments they can, and perhaps concurrently or right after choose a financing mix that minimizes the hurdle rate and maximizes value. And if there is cash left over at the end of this process, and there might not be, they should pay it out to shareholders. So the dividend decision should be the last step in the sequence. That's unfortunately not how, at least for some companies, it works out. There are some companies where dividends actually start the process. These are companies which have paid dividends for a long time and don't want to stop, or they don't even want to reduce dividends, or they're in a peer group where everybody else pays dividends. See the same forces, inertia and Me Tooism kick in? And in those companies, the dividend gets set first, and it then flows into what kind of investments and financing they use. And it can skew your investment and your financing decision. Here's what happens. You decide how much to pay in dividends. You might create capital rationing constraints for you. You don't have as much capital as you need. So you might have to reject some projects that are really good projects you could have taken if you hadn't paid the dividend. In some cases, you might pay too much in dividends. The only way you can cover the difference is by borrowing more than you should. It's dysfunctional because you're letting dividends drive investment decisions and financing decisions, and often in ways that are not going to be good for you as a company. So with that lead in, let's talk about whether we can estimate how much a company should be paying in dividends. Because the very statement that you're paying out more than you should suggests that you can estimate what you should be paying out. And I think you can. In fact, I'm going to use a free cash flow measure called free cash flow equity, but I think a more sensible way to think about it is potential dividend, what you can afford to pay out in dividends. And here's how it works out. You start with net income. Why? Because you're an equity investor. You start with a measure of equity earnings. You add back non-cash charges, depreciation, amortization, other non-cash charges. Why? Because they're expenses that lowered your income, but they're not cash expenses. And then you start writing out checks for different expenses, capital expenditures, acquisitions, working capital going up. They're draining your cash flows. Net income minus that reinvestment gets you pretty close to free cash flow equity. But there's one last stop. If you have debt to be repaid, remember you as an equity investor have to pay out cash. That's a cash outflow. If you raise new debt, it's actually a cash inflow. The net amount has also got to be factored into your free cash flow equity. So basically, free cash flow equity is potential dividend. The way I like to think about it intuitively is this is the cash left in the till for an owner of a business after he or she has met every conceivable need. You can take it out without hurting the business. It is potential dividend. Now, if you look at that calculation, you can already see that free cash flow equity that you arrive at as a bottom line could end up as a negative number. How? You could be a money-losing company, in which case you start with a net loss rather than net income. And if you're a money-losing company with a lot of reinvestment, or even a money-making company with a lot of reinvestment, you can still end up with negative free cash flow equity. If you have negative free cash flow equity, obviously you should not be paying a dividend. And in fact, you need to cover that free cash flow equity. That requires you to go out and raise more equity, issue new shares. Or if you're a private business, bring in new equity into the company. Now, if you take the template for free cash flow equity, you can already see that another favorite structure of mine, the life cycle, comes into play. Because if you think about how these items will evolve over the life cycle, you take a young firm. It's probably going to have negative free cash flow equity. Why? Because you're money losing, you're reinvesting a lot for future growth. No wonder young companies burn through cash. They're called cash burning machines. As you become a growth company and your business model takes form, your losses can start to become profits. But remember, you're still a high growth company. You might need to reinvest a lot. So you might still have negative free cash flows equity. Eventually, though, as growth starts to level off, here's what happens. Your margins continue to improve. Growth starting to level off means you need to reinvest less. Your free cash flows to equity turn positive. You have the capacity to pay dividends or buy back stock. But companies usually don't. Why? Because they keep hoping that they'll become young again. They'll go back to being growth. So at least initially what you're going to see is cash balances accumulate, get bigger as free cash flows equity come in, you choose not to pay it out. At some point, denial no longer works. That you accept the fact that you're now middle-aged as a company and you're starting to go. You're going to have to return cash. If you don't do it, somebody's going to put pressure on you to do it. And that's when you're going to see equity buybacks and dividends show up. And then you're going to decline, your cash return goes into hyperspeed. And here's why. In decline, you're making your company smaller. You're in a sense liquidating your company. You might pay out well above your free cash toward equity as dividends or in buybacks because you're making your company smaller. So you tell me what your free cash flows to equity look like, I can start guessing where you are in that life cycle. Now you're saying, does this actually work or is this something you made up? Well, I make up a lot of stuff. But to show you that there is some basis for the life cycle theory, here's what I did. I took every publicly traded company in 2022, for 40,000 plus companies. I broke them down based on their corporate age. I measure corporate age as the time between their founding, not when they go public, but when they're founding, and 2022. So we were founded in 1950. By 2022, you're 72 years old. I break the companies down by decile, from youngest to oldest. And then I calculated how many of these companies pay dividends and buy back stock. And if you look at the last three columns, you'll see my statistics. About 14.8% of the youngest companies pay dividends, but 76% of the oldest companies pay dividends. Clearly, as you age, you pay more in dividends. Same kind of statistics with buybacks. About 14.2% of companies buy back stock. About 41% of the oldest companies buy back stock. The youngest companies, only 14.2%. If you look at the total cash return, about 1/4 of the youngest companies return cash. 81% of the oldest companies return cash. Clearly, younger companies return less cash than older companies. It's pretty obvious. Why? Because if you look at their net income, 56% of young companies, or 55.5%, if you want to be precise, are money-losing companies. And 60% of young companies have negative free cash flows to equity. So when you look across the life cycle, you can see that the bulk of your dividends and buybacks are going to come from more mature companies in the life cycle. Younger companies are the ones that need the cash. They're going to be going out and raising equity. File that away, because later on we're going to talk about the consequences of restricting buybacks. So that's the big picture. Let's start talking about dividends and buybacks. I want to start because now we have about 4 decades of data on buybacks by stating what I believe are facts, things you can back up with the numbers. And there are 3 basic facts I want to put on the table. Here's the first one. In the US, it's undeniable that there's been a shift away from dividends to buybacks. It's dramatic, it's drastic. So it's not a question of whether it's happening, it's clearly happening. And it's in a sense irreversible, and I want to talk about why that might be. Second fact, much of that shift is being driven by the recognition that there are fewer and fewer firms that can look at their earnings and that I can count on those earnings for the long term. I feel pretty comfortable expecting those earnings to continue to the future. You'll see why this is playing out as more buybacks. And third, I think that at least initially there was the argument that there were buybacks because shareholders were getting tax benefits. I'm going to argue that those tax benefits to buybacks as opposed to dividends have decreased and perhaps even disappeared. So tax benefits might have been an original rationale, but they no longer are. So let's look at those facts. Let's start with the first one. In this graph, I've started in 1988. And to give you some perspective, I first started in corporate finance in the early 80s. And in 1982, 83, 84, about 10% of all cash returned by companies came in the form of buybacks. No, in fact, companies at least pre-1980s returned almost all cash returned took the form of dividends. Starting in the mid-80s, you started to see a shift away. 1988, buybacks were about half of the total, half of dividends or 1/3 of the total cash returned. And over the next 13, 14, 15 years, this number built up. 1998 for me was a benchmark here because that was the year that buybacks actually exceeded dividends for the first time in US corporate history. And buybacks have never looked back. You've had a period like 2009 where buybacks were cut back, and I'm going to come back and talk about why I think that's a good thing to see buybacks drop back so much. But this is a phenomenon that's been building up. In 2022, you might not see that in this graph because 2022 is not quite done in terms of getting the data on buybacks. More than $1 trillion was returned by US companies in the form of buybacks. About 2 out of every $3 returned by US companies took the form of buybacks. Clearly, Companies have shifted, and there are some companies that have never paid dividends but have bought back billions of dollars of stock. So let's think about why this might be happening. And it's not just the US, because a lot of people make the mistake of saying, hey, that's US companies doing crazy things. It is true that the US was one of the highest percentages, looking at 2022 data through January 1st of 2023. The US had about 64% of the cash return, but there are a few markets that are pretty close, right? You've got UK, Canada, you think those Anglo-Saxon markets. Well, Europe is not far back, 35 to 40% of the cash is being returned. The emerging markets, it's true, less cash is being utilized for buybacks, but Latin America is about 25% cash returned is in buybacks. India and China lag. They're about 11%. But there might be a good reason why buybacks haven't picked up there yet, and maybe they will in the future. So clearly, buybacks are here to stay. They're growing, not just in the US, but across the world. And you wonder why that might be. Well, as I said, initially the stories you heard was it's management compensation, and you can tell all of those stories at the margin might explain it, but I think there's a fundamental reason why buybacks have taken such a dominant role. I'm going to say something that might strike you as surprising. I've never understood why why equity investors get dividends that are constant and stable. Why? Because equity entitles you to residual cash flow. It should change over time. Dividends are anything but volatile. They're actually sticky. What does that mean? In most years, and in this graph, actually, I graph out the percentage of US companies each year that do nothing to dividends. That's a blue column. Notice that in every single year, from 1988 through 2021, companies that do nothing to dividends, leave them unchanged, outnumber companies that change dividends. And when companies do change dividends, dividend increases outnumber dividend decreases 3-1, 4-1, 5-1. But here's the ultimate testimonial to how sticky dividends are. Even in years like 2009, horrifically bad year for the market, right? You're in a crisis. Or the first quarter of 2020, dividend increases outnumber dividend decreases. Dividends are sticky. What does that mean? If you initiate a dividend or start paying a dividend, it's very difficult to step back, especially if earnings drop and you're in a different environment. Dividends don't make sense, especially when earnings have become more volatile. Businesses face more risk. So I think a big driver of buybacks is they're more flexible. They allow you to adjust much more quickly to circumstances around you. Remember the graph I showed you about buybacks in 2009? That's the right thing to happen. You want cash return to drop off during a crisis, and it did in 2009. First quarter of 2020, companies are worried. Dividends stayed pretty stagnant. There were a few companies that cut dividends. Buybacks dropped by about 50%. Buybacks are flexible. In fact, I use an analogy that in my corporate finance classes, I said dividends are like getting married. In good times and in bad times, in health and in sickness, for the rest of your life, you're stuck. Buybacks are like hooking up. You have a good time, goodbye, I won't see you again. In a sense, it reflects the fact that you're not committed to making those buybacks in the future. So with that lead in, let's think about the third fact on dividends, which is, I told you that when we started the process in the 80s, dividends had a significant tax advantage. Buybacks had a significant tax advantage. And here's why. For the 20th century, almost all of the 20th century, dividends were taxed as ordinary income, which meant that you paid ordinary income taxes, and buybacks were taxed as capital gains if you held for more than a year. Take a look at the difference between the dividend tax rate and the capital gains tax rate. In fact, the puzzle is not that companies started doing buybacks in the 80s. It's why they didn't do more buybacks pre-1980, because the tax difference was actually greatest then. For the first 20 years, you could make this argument that you still have a big tax advantage from capital gains, and that's why people are buying back stock. Because here's how it works. If you pay a dividend, stockholders in your company get the dividend. They have to pay taxes that year. You have no choice on timing. It is income that year. If a company buys back stock and you choose to sell your shares back, then it's a capital gain that year. If you choose not to sell your shares back, it's an unrealized capital gain, which means you can wait for another year, put it off into the future to pay your taxes. So that was the story for the bulk of the 20th century. In 2003, for the first time in almost a century, the tax rate on dividends and capital gains in the US converged with that tax code change of that year at 15%. They were both taxed at 15%. And since then, they've locked in at the same rate. It's now 23.8%. If you include the fact that you have to pay Medicare taxes on top of capital gains taxes, don't get me started on that. But it's the same tax rate. There still remains a small advantage with buybacks, which is that you have a timing option, which is you decide when to pay your taxes. But it's a much smaller benefit than it was 20 years ago or 40 years ago. So those are the facts on buybacks. But there's a lot of fiction about buybacks. In fact, there are 4 fictions I want to address frontally. The first is a fiction that's shared by both buyback advocates and buyback critics. Buyback advocates keep telling me that doing a buyback will increase your value per share, that this is good for your stock price. Is that true? And then buyback critics push back in the opposite direction. They say buybacks are bad for value. They're both wrong. Buybacks cannot increase value or decrease the value of a business. They can redistribute value. It's mysterious, but I'll come back and address that. The second is that the surge in buybacks, especially in the US, and this is directed at US companies, has been fed by debt financing. In this story, you have heavily levered companies borrowing more and more to do buybacks that are going to greedy short-term shareholders. Not a very nice story, but a story nevertheless. The third is that buybacks are bad for the economy. And here's how the reasoning goes, that money, the $1 trillion that's being used in buybacks, is not being invested back in the companies doing the buybacks, which is absolutely true. But then they say that must mean there's less money being invested in the economy. That's not good for the future of the economy, so we should stop buybacks. We'll come back and address that argument. And the final argument is that when companies pay out billions, tens of billions, hundreds of billions in buybacks, that it's not fair to the other stakeholders in the company. Who are those other stakeholders? That the 10 billion you did in a buyback could have been used to pay your employees more or to give your customers a better product or a better service or lower prices. And as a consequence, the argument is it's unfair that companies are able to buy back shares where other stakeholders are suffering. Let's look at why each of these is a myth. Let's start with the value effect of dividends and buybacks. Let's step back. Let's think about what happens to a company when it pays a $100 million dividend and buys back shares with $100 million. Cash leaves the company, right? The company gets smaller, cash leaves the company. By itself, that's a neutral effect. Now, what can affect value is A, how you come up with the funds to do your buyback. If you're borrowing money, then that borrowing can affect value, and it can affect value by changing your cost of capital. In which direction? Depends on whether you start as a company that has too little debt. Remember in the last post we talked about too little or too much debt. If you're a company with too little debt and you borrow money to do a buyback, you will see an increase in value. It's really a tax subsidy that you're getting from the government. You get an increase in value, but it's not because of the buyback. It's because you borrowed money to get closer to the right mix. If you're a company that's already at the right debt ratio or over-levered and you go out and borrow money to do a buyback, you'll hurt yourself. And again, it's not the buyback that's the reason. It's the fact that you borrowed money and made yourself over-levered. Your cost of capital will go up, the failure risk goes up. So that's the first consequence of dividends and buybacks. The second consequence is by doing a buyback, you might not be able to take investments that you otherwise were planning to take. Is that good or bad? Well, it depends on the quality of your investments, right? If you're a company with great investments and you're rejecting those investments or not taking them because you're using the cash for a buyback, you are doing damage to yourself in terms of value. Your value will go down. But if you're a company in a bad business, your projects are not that good, you know what? Not taking those investments will actually make you a more valuable company. Growing at a slower rate, shrinking will make you a more valuable company. So it's not the buyback per se that is affecting value. It's how it's funded or what effect it has on investments. So here's the bottom line. Dividends and buybacks cannot really affect value unless you bring in either debt or investment effects. But there's a difference between dividends and buybacks on whether they can redistribute value. Dividends are, everybody gets the same dividend. There's no, so if it's a bad dividend, everybody gets hurt badly. It's an equal opportunity, helper or hurter. Buybacks are different, right? When you do a buyback, there are people who sell their shares back and people who continue with the company. Now, when you buy back shares at too high a price, in other words, let's say you're overpaying. You know what happens, right? If you overpay, the people who sell their shares back gain at the expense of the people who remain shareholders in the company. You're moving wealth from people who stay shareholders to the people who sell their shares back. So buying back shares at too high a price redistributes value. It doesn't increase value or reduce value, redistributes value from the shareholders who remain to the shareholders who sold their shares back. If you buy back shares at a price lower than your value, then the reverse happens. The shareholders who sell their shares back are having value moved from their side to those shareholders who remain in the company. Finally, if you buy back shares at a fair price, close to the intrinsic value, there's no effect. Neither side will be affected. Now do you see why, Warren Buffett at Berkshire Hathaway, when he instituted the buyback policy, and you can go back and read his original policy, also put in a condition. He said he would buy back shares only if he felt that the price was less than the intrinsic value. Now, most CEOs, when they say that, your reaction is right, because most CEOs wouldn't know the intrinsic value if it kicked them in the face. With Warren Buffett, you start with the presumption that this man knows what he's talking about with intrinsic value. So I think that it is true that buybacks can redistribute value. And there are some people who argue that that's why you should let companies buy back stock. They say, if I'm a shareholder in a company and let them buy back stock at a high price, there's going to be value redistributed from me to those people who sell back. But you don't have to ban buybacks to prevent this from happening. If you really think the company owns shares and is buying back shares at too high a price, you know what you should do? Just sell your shares back. You don't have to bitch and moan about too high a price. Be on the right side of the redistribution game. So I've never understood shareholders who complain that a company bought back shares at $70, the stock is now $25, and they should not have bought back at $70. To which my reaction is, why didn't you sell it to them at $70? What stopped you? So buybacks cannot add or destroy value, they can redistribute value. Now, as for the story that buybacks are being funded with debt and US companies are getting incredibly levered, hey, I've got to be quite honest, buyback critics just are making up stuff. Let me back this up. In 2022, I looked at companies that bought back stock versus companies that did not buy back stock, and I looked at two measures of how much debt they had. One is the total debt to capital ratio in market terms, and the second is the total debt as a multiple of EBITDA. And remember, the higher this number, the more debt you have. So here's what I saw. If you look at all buyback companies, their debt ratio is about 33 to 34%. But if you look at companies that don't buy back stock, their debt ratio is 66%. You look at debt to EBITDA, companies that bought back shares have a debt to EBITDA of 4.1. Companies that don't buy back, you tell me based on those numbers, which of these two companies looks like it's using too much debt? So if you're going to make an argument that there are some companies that are borrowing to do buybacks and essentially getting overlevered, of course there are. Of course there are. But clearly that's not the rule. That's the exception. So if you hear the argument buybacks are being funded with debt, your response should be show me. I want to see the data. Don't give me anecdotal evidence of some company that did it. Show me in the cross section that this is true. I stuck with just US companies for this graph because this argument that buybacks are funded with debt has been primarily focused on US companies. Let's talk about this. Now, last year when the bill that increased the buyback tax was being debated, I made the mistake of actually listening to the Senate debate on this issue. I should have known better because I saw a mix of ideological arguments and ignorance driving the debate. In fact, I know many of the people who are pushing for a 2% tax rate on buybacks, and perhaps an even higher number, made the argument that buying back stock is bad for the economy because when a company spends $1 billion in a buyback, it's not investing the billion back into the business. Mathematically, that's true, right? You pay it out, you can't invest it. But there are two problems with this argument. The first is the assumption that investing is always good, that a company that invests is good for the economy. Let me ask you a question. Would you have wanted Bed Bath & Beyond to keep building new stores for the last decade? I didn't. This is a company that mastered the art of destroying value, right? How is that going to be good for the economy? Or in a different example, and this might sound cruel, but I'm going to say it anyway, wouldn't we all have been better off if GE had just liquidated itself as a company in 2010 and returned the cash to its shareholders? I mean, we wouldn't have the Walking Dead company that's creating pain as it continues, right? So that's the first problem. The assumption that investing is good and not investing is bad is so deeply entrenched in the political psyche that it shows up in these debates. But even if you overlook that argument, the second thing is, what do you think happened to the $1 trillion that were returned to shareholders in buybacks? They didn't disappear into some black hole. You know where they went, right? They went into other companies that needed the cash. Remember the life cycle? These young companies are cash burning machines. They need capital. Where do you think that capital comes from? So the real question is not whether you want investment in the economy, but who should be doing the investment. Do you want to be old-time companies whose best days are behind them, who are in bad businesses? Or do you want younger, more dynamic companies that need the capital, are disruptors perhaps, that can change the economy? That should really be the core argument, not is this company investing or is it not? Which brings me to the final argument of fairness. And I have some sympathy for this argument, because I do understand that wages have dropped over the last 40 years, the inequality gap has increased, and you're saying buybacks caused that. Well, I don't think you can blame buybacks, but you could argue that that money maybe should be used to raise wages. No. But I think that that's an argument about profits. It's not about buybacks. You're asking, are shareholders making too much profits? And at least based on my fifth post, the answer is not really, right? 70% of companies are not earning their cost of capital. It's not like companies are getting incredibly profitable in the aggregate and making huge returns. But here's another test. And I'm unable to do the data test on this because I don't have the data on a segment of what I need. I'll wager that if you looked at employee wages and benefits, that companies that do the most buybacks pay the highest wages and treat their employees better than the companies that don't do the buybacks. And the reason is simple. Companies that find themselves prosperous enough to do buybacks can often afford to do other things as well. As I said, I don't have the data to back this up. If any of you have data at the company level on employee wages and employee benefits, I'd encourage you to run that table based on deciles of companies doing buybacks. And let's see if in fact buybacks are coming at the expense of employee wages and benefits, or whether they're coming at the expense of product quality. I mean, again, anecdotal evidence can be provided, but anecdotal evidence proves nothing. So what's the bottom line? I think it's telling that some of the, I won't use the words of Warren Buffett, of economic illiterates and what was the other word? Demagogues. But I do think there's an ideological component to buybacks, which is that, buybacks are viewed as going to wealthy people, and there is at least this sub-message that wealthy people already have enough money, so we should make it more difficult for them to get more money. But if you're taxing buybacks, do it at least because you want the money. I know that we run a deficit, we need tax revenues, and this might be an easier way for you to get tax revenues than taxing corporate income. But remember the law of unintended consequences. I'd remind you that in the early 90s, I think it was 1992, Congress looked at top management compensation, CEO compensation, and they decided that CEOs were being paid too much. And they decided to pass a law to cap management compensation. But at that time, the way they wrote the law was in terms of bonuses and salary, because that's what was out there as the way managers got compensated. So they write the law, and guess what companies discovered they could do? They could give options, and it didn't fit in under the restrictions of the law. A law designed to keep compensation in check gave rise to a phenomenon that caused management compensation to explode out of the box: stock-based compensation. You got to be careful when you write laws to fix a problem that you don't create further problems. My concern is that in the zeal to tax buybacks because you view it as a bad thing, you're basically going to create a different way of returning cash. Special dividends, special dividends that might not get taxed but have worse consequences than buybacks do. And if the end game in buybacks is not to get tax revenues to change corporate behavior, I'm skeptical that it's going to work. If you're in a bad business, encouraging companies not to buy back stock or putting restrictions on them is just going to lead these companies to develop big cash balance. It's not going to get invested. It'll be for the most part futile. But if it does work, in other words, you change corporate behavior and those bad companies invest more, it'll do more harm than good for the economy. So I hope we found the session useful. And the next time you're a debate about buybacks, I hope you can jump in and provide some data perspective, because there's a lot of stuff that people are making up in this debate that you need to push back against. Take care and have a good day.